You know that sinking feeling when you finally buy something and the price immediately drops? You buy a new gaming laptop and the next day it's $300 cheaper. Now imagine that feeling, but instead of a laptop, it's your entire savings. You bought Bitcoin at $103,000 in late 2024. You did the research. You listened to the podcasts. You saw the headlines. BlackRock, Fidelity, the smart money was finally piling in. And now, you're watching it bounce around like a pinball between $84,000 and $97,000. You keep asking the same question everyone is whispering. The ETFs are here. The institutions have arrived. So why aren't we at $150,000? What am I missing? My name is James, and I've spent the last decade obsessing over why markets behave irrationally. If you're someone who bought Bitcoin anywhere between launch and now, who believes in the code, who understands the supply cap, but can't figure out why the price action feels like a rigged game compared to the adoption news, smash that like button and subscribe. This might be the most important context you get all year. I wasn't going to make this video. The banks are manipulating the price. Narrative always felt like a crutch, an excuse people use when their trades go red. It sounded like something posted from a basement at 3 a.m. with zero receipts. But then I started digging into the actual, legal, boring-as-hell mechanics of how modern finance can squeeze an asset without ever breaking a rule. And what I found genuinely made me reset my perspective. We aren't talking about a shadowy cabal in a smoke-filled boardroom. We're talking about public financial instruments, historical playbooks over a century old, and a specific company that might be walking into a trap that has been set for empires. And here's the part most people miss. The exact same leverage loop that strangled nations in the 1980s, the exact same debt mechanics that wiped out hundreds of companies during the early 2000 credit bust, are currently sitting in plain sight, wrapped around the largest corporate holder of Bitcoin in the world. If you own crypto, you need to understand this labyrinth. So, let me start with a story that sounds like history class, but I promise it is the master key to understanding the next 18 months. Back in 1982, Mexico did something that seemed incredibly smart. They borrowed billions from international banks to build infrastructure, fund growth, and secure their future. Smart, right? Except for one tiny, fatal detail. That debt was denominated in US dollars, not pesos. Why does that matter? Because Mexico can't print US dollars. They have to earn them. So, when Paul Volcker at the Federal Reserve jacked up interest rates to kill inflation, the dollar skyrocketed. Suddenly, Mexico's debt payments exploded overnight. The peso collapsed. They owed $80 billion they couldn't pay. The IMF rode in on a white horse with a rescue package. But that package came with chains. Mexico had to privatize its oil, cut its social programs, and open its markets to foreign vultures. They had to sell the family silver to pay the bank. This wasn't unique. It happened to Argentina, Brazil, Indonesia, dozens of times. It's called a debt spiral. Now you're thinking, Tom, what does 1980s Latin America have to do with my crypto portfolio? Everything. Because that spiral isn't about geography. It's about leverage. When you own money in an asset you don't control, you don't just risk bankruptcy. You risk losing your sovereignty, your ability to make rational decisions. And here is the kicker. This mechanism doesn't just apply to countries. It applies to companies. And right now, there's a company holding over $40 billion in Bitcoin that is structured in a way that makes it vulnerable to the exact same psychological trap. Let me bring it home. Imagine you own a house worth $500,000. You take out a home equity loan for $100,000 at a variable rate. Payments are easy. Life is good. Then rates spike. Your payment jumps from $400 to $1,200 a month. Your salary didn't change. Now you have three options: sell the house, refinance with more debt, or default. The moment you start worrying about making that payment, you stop thinking straight. You might sell a loss just to stop the bleeding. You might take a terrible refi deal just to buy time. And the bank? They're just sitting there, knowing you're trapped. This isn't a crime, it's structure. Now scale that up. Instead of a house, it's $40 billion in Bitcoin. Instead of a home equity line, it's $16 billion in convertible bonds and preferred shares. And instead of a random homeowner, it's a publicly traded company whose stock price dictates whether they can hold their Bitcoin or dump it on the market. That company is MicroStrategy. And understanding the pressure cooker they are sitting in is the key to understanding the last 6 months of price action. On paper, MicroStrategy sells business intelligence software. But let's be real, that's a hobby. What they've actually become is a leveraged Bitcoin fund wearing a corporate mask. They raise money 3 ways. They sell stock, they issue convertible bonds, and they sell preferred shares. Then they take that cash and buy Bitcoin. As of now, they own a mountain of it. They paid billions. They're sitting on massive, unrealized gains. Sounds genius, right? Here's the catch. Those bonds and preferred shares have teeth. They have interest payments and mandatory dividends. We're talking about roughly $700 million a year just in servicing costs. Almost $2 million a day. Where does that cash come from? Their software business kicks off maybe $100 million a year. That's a drop in the bucket. So they built a cash reserve, about $1.2 billion specifically to pay these bills. At the current burn rate, that reserve lasts about 20 months. Less than 2 years. This is where the trap snaps shut. Here is the financial engineering at play. MicroStrategy stock usually trades at a premium to net asset value. That means the market values the company higher than the Bitcoin it holds. Why? Because investors bet they'll buy more Bitcoin and the price will go up. As long as that premium exists, MicroStrategy can sell stock, buy Bitcoin, price goes up, stock goes up. It's a beautiful flywheel. But what happens if that premium vanishes? What if the market decides, actually, we think your structure is risky, so we'll only value you at a discount to your Bitcoin holdings? Suddenly, they can't sell stock anymore. Selling shares at a discount would be like selling Bitcoin at a loss. So the equity spigot turns off. Now, that $1.2 billion cash reserve is the only wall between them and a fire sale. 20 months. Tick-tock. If they start selling Bitcoin to pay the debt, the price drops. If the price drops, the stock drops further. If the stock drops, they have to sell even more Bitcoin. That is the death spiral. Now, why would anyone want this? Why would institutions push them toward the edge? Here is where the psychology gets dark. Imagine you're a massive investment bank. Your clients, pension funds, sovereign wealth funds, want Bitcoin, but they can't buy it at $95,000. It's too volatile, too hard to custody. But what if they could buy it for $70,000? If MicroStrategy gets squeezed, they won't sell Bitcoin on Coinbase. They'll do a block trade. They'll call the big banks and say, we need to dump $5 billion. Who wants it? And the banks will say, sure, but we want a 15% discount for taking it off your hands. Suddenly, the banks acquire billions in Bitcoin at a massive discount, which they then sell to their clients at a markup or hold it themselves. They get rich. To make that happen, they need MicroStrategy to be desperate. They need the stock to fall. They need the pressure to build. How do you build pressure? You short the stock. Let me be crystal clear. I am not alleging a conspiracy. I don't have a tape of bankers plotting, but I have history. In the early 2000s, there was a financing weapon called a floorless convertible. A struggling company would borrow from a hedge fund, and the lower the stock went, the more shares the lender got. The incentive? Drive the stock into the dirt. The SEC investigated hundreds of these. Companies that took these deals saw their stocks fall 34% on average. Almost half were wiped out completely. Legal. Devastating. MicroStrategy doesn't have floorless converts, but the dynamic is the same. If you're a hedge fund betting they'll fail, you short the stock. You publish research. You create fear. In February 2025, MicroStrategy stock fell so low, you could effectively buy Bitcoin at an 18% discount just by buying the stock. The market was pricing in the risk of the spiral. During that time, short interest was massive. Billion-dollar bets against them. Names like Jim Chanos went public. JP Morgan published reports questioning the structure. Is that manipulation? No, it's analysis. But the net effect is pressure on a structurally vulnerable company. Here's what most people don't get about modern financial warfare. You don't need to break rules. You just need to understand the incentives and exploit them. It's poker. You don't need to see their cards. You just need to know when they're pot committed and apply pressure. If you're Michael Saylor, watching your stock get shredded, what do? Buy more Bitcoin? Hope? Raise money and dilute shareholders? Or sell Bitcoin? The one thing you swore you'd never do? You're stuck. And the people shorting you know you're stuck. They're betting that eventually the pressure cracks the dam. So if this is real, what do? Should you sell your Bitcoin and hide in cash? No, absolutely not. Here is why the people who understand this dynamic win. First, MicroStrategy is not Bitcoin. Bitcoin is a decentralized network. MicroStrategy is a company with a specific, risky capital structure. If they fail, it doesn't mean Bitcoin is broken. It means a specific CEO made specific bets with specific terms. Second, this pressure creates opportunity. If institutions are trying to force a discount sale, it means they want the asset. They believe in the long-term value. They're just trying to buy your coins for 70 cents on the dollar. If you're a long-term holder, panic selling during manufactured fear is exactly what they want. They want your coins at $85,000 so they can sell them to their clients at $150,000 in 2 years. Third, watch the timeline. 20 months. That's the clock. Markets hate uncertainty, and that clock creates volatility. But if Bitcoin recovers before then, if they refinance, if they raise capital, the death spiral thesis evaporates. Let's do the math. Say you bought at $100,000. You're down. If you panic sell at $80,000, you lock in the loss. But if you understand the game, when the price drops to $78,000 on some MicroStrategy bankruptcy fears, you see it for what it is, a sale. You buy more. 6 months later, the spiral resolves. Bitcoin hits $140,000, and you've doubled your position. The psychology is the edge. This is how wealth transfers happen, not through fraud, but through psychology. Retail sees a drop and screams sell. Institutions see a drop and ask, is the thesis dead? If the answer is no, they buy. This happened with gold in the 1990s. Central banks sold at $275, calling it a barbarous relic. Smart money accumulated. 20 years later, gold hit $1,900. The sellers looked like fools. So, here are your action steps. 1. Don't panic sell. Volatility is the fee for admission. Ask if the fundamentals have changed. They haven't. 2. Watch MicroStrategy's cash reserves. If they start selling, that's a signal. Until then, it's noise. 3. Diversify. Don't bet the farm on any single narrative. 4. Educate yourself. Learn what a convertible bond is. Learn what short interest means. The person who understands the tools has the advantage. The reason I walked you through 1982, through floorless converts, through the MicroStrategy labyrinth, is to show you that financial engineering is a weapon. It can build wealth or extract it. Most people just see their portfolio going red and think they were wrong. But you weren't wrong. You were just playing a game whose rules you didn't fully know. I'm not here to tell you Bitcoin is going to $1 million tomorrow. I'm here to show you how the game is played. Because investing isn't about being right. It's about understanding risk, managing your emotions, and letting time work for you while everyone else chases shadows. If this helped you see the matrix, hit subscribe. Drop a comment. Is this a real spiral, or am I just connecting dots? Keep learning. Keep digging. The best defense against manipulation is understanding. Know what you own, know why you own it, and know when someone is trying to play games with your patience. I'll see you in the next one.